What if you could find easy, repeatable patterns that happen around market holidays and other recurring events? If you knew how to take advantage of them, you could greatly increase your yearly return with just a few more trades a year. In this video, we show you an example of one such pattern and teach you the process for thinking about and finding such patterns. I'm Seth Freudberg, the head options trader at SMB Capital, and we're one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. You've found the right place to learn. Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And one of the major reasons that we've developed so many 7 and 8-figure traders over the years is because we've encouraged a strong culture of information sharing. It's incredibly powerful for traders to share information with each other. Not only can more traders take advantage of emerging trading opportunities that way, but just as importantly, by sharing information with other talented traders, you get the benefit of their perspective and insights, which in some cases can give rise to an even better opportunity than the one originally shared. In today's video, we're going to be going over a pretty amazing example of this kind of information sharing and idea generation, which can lead to incredible trading opportunities. Now, before we get into the details of a powerful trading idea that emerged from traders communicating ideas with each other, I wanted to let you know that beyond what we'll be teaching you in this video, if you'd like to learn 3 more option strategies that our pro traders use all the time, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. The strategy that we're going to be talking about today involves stock options for the Qs, QQQ, which is the exchange-traded fund that mirrors the NASDAQ 100 index. Now, I realize that most of you know something about how stock options work, but just for a quick review, and this is going to be fast. What's known as a call option on a stock entitles the buyer of that option to buy 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at any time before that option expires. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading at any time before that option expires. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock's going way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price, paying way below market. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put. Now, on the other hand, at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless and the call seller just pockets the premium. Similarly, if you sold a put and the market closes above the strike price of that put, then unless the put was previously exercised, it expires worthless and the call seller just pockets the premium. Okay, so with that in mind, you might recall that in our options trading video that we shot a few weeks back, we went over a 2-day option strategy known as the Iron Butterfly, which is initiated the Wednesday before Thanksgiving and was subsequently closed the next trading day around 1 p.m. on Friday, which is a half-day market session stuck, annoyingly, in the middle of Thanksgiving weekend. So in any event, if you saw the video, you'll know that the original idea that one of our traders on the desk had was actually kind of the opposite of the trade we ended up concluding was the better trading idea. What he was contemplating originally was what is known as a long at-the-money straddle that he thought might be a successful trade by buying 25 calls and 25 puts at the same strike price as the Qs were trading that day, what options traders refer to as at-the-money options. And because each option represents 100 shares of stock and we bought 25 of each, with the calls priced at $2.07 and the puts priced at $1.75, the resulting overall cost was $9,550, as you can see from the calculation. And the basic idea behind a long straddle is that if the stock in question makes a very large move to the upside, then the calls will get very valuable while the puts will expire worthless. And similarly, if the market goes down by a lot, the puts will get very valuable while the calls will expire worthless. But what the trader discovered in his research was that more often than not, the market would not move enough to overcome the total cost of the straddle, that $9,550. And so when it came to close the trade, he ended up cashing in either the call side or the put side, and he would cash them in for something, because the market, of course, has to go either up or down, obviously. But if that move is not large enough, then the trade loses because he cashes the straddle in for less than he paid for it. So what we decided to do was to actually look at flipping this trade on its head. And instead of buying the at-the-money straddle, we decided instead to sell it, meaning we'd receive the $9,550 instead of paying for it in a transaction known as a short straddle. And the concept behind that idea was that if the original long straddle idea was a consistent loser, then the opposite, the reverse of that trade, may well be a consistent winner. However, because your broker will not let you enter into a short straddle without requiring a massive amount of capital, the short straddle trade is not really viable because its capital requirements are prohibitive. And so the way that it's solved is to buy what are known as wings, which are long options located normally equidistant from the short options, which in this case were located as calls at a higher strike, 7 points above the short 286 calls up at 293, and we also buy puts 7 points below the market down at 279. And so when we do that, we've actually turned the trade into what options traders refer to as an iron butterfly. And when you buy the wings and turn the trade into an iron butterfly, it drops the capital requirements down on the trade immensely. Although, as you can see, we have to pay for those wings, which cost us under $1,000, as you can see from the subtraction of $375 and $550 from the premium we're receiving by selling the straddle at $286. And so initially, you actually start out with positive cash flow of $86.75, and your broker's capital requirements are much more reasonable, which in this case turns out to be $89.25, which is actually less capital than is required to buy the long straddle that got this whole idea started in the first place. And so the Qs closed at 286.92 on the Friday after Thanksgiving, as you may recall. And so we talked about how the trade would settle. And remember, we still have that original 86.75 of cash flow, plus 3 of the 4 options expired with no value, as you can see, because both the short and long puts expired below the closing market price. And so those have no value, as we discussed earlier. And the long calls up at 293, they also had no value, as those expired above the market price. And so the only option that had any value at all were the short calls at 286, which we would have been able to buy back right before the close for about 92 cents, resulting in a 71% return in 2 trading days. Now, this is actually where it gets interesting. You see, at SMB, we have a group mentoring process for options traders from all over the world, and it's known as the Options Tribe Trading Team, which is a group of about 50 options traders who share information with each other during the market day in Slack, and every Tuesday, one of our members presents how he or she trades to the other members. So after a year, almost all of our members have presented their trading style to the others, which turns out to be incredibly valuable because each presenter goes into great detail about the steps and decision points in the options trades that they typically make. And so by the end of the year, you have the trade plans of dozens of really talented options traders. And so one of our members is a guy named Robert, and he runs a software business in Asia, and he's trained one of his employees, a very nice lady named Furley, to collaborate with him in trading Robert's trading account using the strategies that we teach at SMB. And Robert and Furley are very familiar with the iron butterfly strategy, and so they watched last week's video, and it occurred to them that it would make sense to take a look at a longer time horizon and see if this 2-day iron butterfly trade around Thanksgiving actually has long-term edge. And what they came up with is pretty compelling, and that is if you were to have gone back over the last 10 years and open up an iron butterfly expiring in 2 calendar days on the Wednesday before Thanksgiving, using about the same amount of capital as we showed you in this example, and went ahead and closed it at 1 p.m. at that early close on the Friday after Thanksgiving, and if we had religiously executed this trade every year for 10 straight years, it would have yielded 155% on the capital deployed in the trade, or a return of 15.5% per year on average. And remember, this one trade only ties your capital up for 2 days. Now, of course, you're going to experience drawdowns with this strategy, as you will with any strategy. And as you can see, the first few years actually would have been rough sledding. But since this only can be traded once a year, you need to look at this longer time horizon, which seems to show some pretty solid edge, even including those first few rough years. And because the drawdowns you'll need to tolerate can be large at times, what we advise our students is that for trades with this kind of an occasional drawdown potential, you don't want to commit large amounts of capital to it, but rather regard it as a smaller component of your overall trading, and that you adopt strategies with a lesser drawdown profile for larger amounts of capital, which will make your trading practice much more emotionally tolerable and satisfying. And so what I'd like you to take away from today's video is that there are seasonal trades like this Thanksgiving iron butterfly, which show a long-term edge if you study it, and the returns are often fantastic. Now, just suppose that you could find 4 or 5 other short-term seasonal trades with edge throughout the year. Imagine how that would juice up the returns on your account after a full year, as long as you were consistent with the trades year in and year out. Backtesting a strategy not only proves whether the strategy has edge or not, but, and this is crucial, it gives the trader confidence that if he's consistent in the use of the strategy, history would tell us that he'll be able to produce a very attractive return on his account, especially if he's able to identify 4 or 5 of these seasonal trades throughout the year. That's how pro traders think, and that's how you should as well. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.
So you're an active trader, not doing as well as you want, not doing as well as you deserve, and you just can't figure out why you can't become profitable no matter how hard you try. Well, let me show you why. This is your competition. The traders in this room. This room right here is full of elite traders, some of whom are making 7 and even 8 figures a year. In fact, our top guys have made nearly 20 million each in net trading profits in a single year. Let's head to my office so I can share more. So you're probably used to seeing videos of lavish trader lifestyles, trading gurus trading off of a laptop for an hour a day, heck, maybe even 15 minutes a day, and then them relaxing on some secluded beach for the rest of the day. Well, all I can tell you is that our traders train like pro athletes. They live and breathe the markets and are continually working on their trading skills because at our firm, that's what we found it really takes to make it in this game. I'm Mike Bellafiore, co-founder and managing partner of S&B Capital, one of the world's top proprietary trading firms located in Midtown Manhattan. And we're always looking for trading talent to hire and develop. And not just to trade in-house on our desk, but also to trade from their own home, entirely using our firm's capital. And we have numerous traders doing just that, allowing them to make upwards of 7 figures trading the firm's capital without risking their own money. But to even get a shot at something like that, you need to have the right training. That's why we're doing a new free online presentation in which we share how you can get an interview with SMB to become an in-house or remote trader, trading firm capital without risking yours and gaining access to all of our firm's coaching and resources. And the best part? You don't have to be a profitable trader yet. In fact, we prefer to mold profitable traders with our methods and our techniques. That's why we have just 3 simple criteria that can earn anyone an interview. We're looking for highly ambitious and determined traders who fit our culture first and foremost. So if you believe that could be you, sign up for the free 1-hour online presentation by clicking the link that's in your top right corner of your screen now.